Today, a technology company that you might not even be able to name, they just raised $26.5 billion in a single afternoon.
Right, which is just a staggering amount of money.
Yeah, Wall Street was in a state of absolute euphoria. Like they were throwing capital at this firm as if it were the key to human evolution.
Yeah.
But on the exact same day, in the exact same economy, Walmart had to slash the price of ground beef and Coca-Cola.
Yeah, because their internal data show that the American consumer is just financially tapped out. I mean, they're physically walking away from the meat counter.
Exactly. It's a massive disconnect. So welcome to the deep dive. We are looking at a very specific stack of sources today.
Yeah.
We've got global market data, corporate earnings, federal regulatory decisions, and macroeconomic labor reports.
Yeah.
And they all landed on July 10th, 2026.
Right, a really heavy data day.
Yeah. And our mission today is to figure out what happens when the infrastructure of tomorrow violently collides with the economic reality of today. And, we're going to look at the mechanisms driving both of these extremes.
And I think the reason you, as the listener, need to pay close attention to this stack of data is that, well, this collision isn't just theoretical anymore.
No, not at all.
Whether you are actively managing a stock portfolio or you're trying to negotiate a salary in a shifting job market or, just sitting at the kitchen table trying to map out a retirement plan, this disconnect between high-flying corporate valuations and ground-level cost of living pressures, it's going to dictate your options.
Yeah, it hits your wallet directly.
Exactly. You really cannot navigate what is coming without understanding the mechanics at both ends of the spectrum.
So I want to start at the absolute top of the economic food chain, like the capital flowing into the hardware that powers artificial intelligence.
The pickaxes of the gold rush.
Right. The source material highlights SK Hynix, which is a South Korean memory chip manufacturer. They just made their NASDAQ debut, and they raised $26.5 billion by selling American depository shares, or ADRs, at $149 each.
And the market loved it.
Totally. The stock immediately surged, I think between 13.5% and 20% in midday trading.
Yeah.
But before we even get into the AI of it all, help me understand the plumbing here. Like, what actually is an American depository share? And why is a South Korean company raising billions in New York instead of just, relying on their home exchange?
Well, it really comes down to liquidity and access. An American depository receipt, or an ADR, is essentially a financial bridge.
Okay.
Because if you're an average investor in the United States or even a mid-sized institutional fund, buying shares directly on the Korea Exchange in Seoul involves, well, a lot of hurdles. You're dealing with currency conversion, foreign tax laws.
Right, time zones, all that.
Exactly. Navigating different regulatory frameworks. It is a massive friction point.
So it's just a hassle most investors won't bother with.
Precisely. So to remove that friction, a U.S. depository bank will essentially step in and purchase a massive block of shares of SK Hynix directly on the foreign exchange.
Okay, so the bank holds the bag, so to speak.
Right. The bank holds those actual shares in a vault, metaphorically speaking, and then they issue receipts, which are the ADRs on a U.S. exchange like the NASDAQ. So these receipts track the price of the underlying foreign stock, but they trade in U.S. dollars during U.S. market hours, and they settle through standard U.S. brokerage accounts.
Oh, wow. So by listing ADRs, SK Hynix just instantly gains access to, what, the deepest pool of capital on the planet?
The most aggressive pool of capital on the planet yet.
Which totally explains that $26.5 billion number. I mean, this is the largest first-time share sale by a foreign company we've ever seen. And if you look at their native stock in Seoul over the last 12 months, it's up over 634%.
It's astronomical.
So the obvious question is why? Because when I think of the AI boom, the infrastructure powering these massive language models, I think of NVIDIA, I think of processing power. But SK Hynix makes memory. Why is the market valuing short-term data storage at such an insane premium?
Because memory is the absolute physical bottleneck of modern artificial intelligence. To really grasp this, we have to look at how a computer actually, thinks.
Okay, break it down.
So NVIDIA designs the graphics processing units, the GPUs. These are the engines that perform the complex mathematical calculations required for AI.
Right, the brains.
Yeah, but a GPU is totally useless if it doesn't have data to calculate. It needs to pull information in, process it, and push it back out.
It needs a desk to work on.
That's a good way to put it. Think of the GPU as like the fastest, most brilliant chef in the world. The chef can chop vegetables at lightning speed, but the memory is the waiter bringing the vegetables from the fridge to the cutting board.
Oh, okay, so the chef is waiting around.
Exactly. Historically, the chefs became so fast that the waiters just couldn't keep up. The GPUs were sitting idle for fractions of a microsecond, just starving for data.
And I guess in the world of AI, where you're processing trillions of parameters, those microseconds add up.
They compound into massive, massive inefficiencies.
So SK Hynix basically figured out how to make a faster waiter.
They did. They mastered a technology called high bandwidth memory, or HBM. So instead of placing the memory chips next to the processor on a motherboard, HBM literally stacks the memory chips vertically.
Like a skyscraper.
Like a skyscraper, exactly. One on top of the other. And they place them microscopic distances away from the GPU. They use these tiny microscopic wires called through-silicon vias to punch straight down through the stack.
Wow, so it's a direct pipeline.
Right. It creates a massive, ultra-fast data highway directly into the processor. And SK Hynix positioned itself years ago as the undisputed master of this very specific, highly difficult manufacturing process.
So they have a monopoly on the waiters.
Basically, yeah. NVIDIA literally cannot achieve their stated AI performance metrics without SK Hynix's HBM components.
Okay, that definitely explains the euphoria. If you want to build an AI data center, you literally have to pay the toll to SK Hynix. But this is where the market behavior gets deeply confusing to me.
How so?
Well, our sources show that on the exact same day SK Hynix is surging 20%, another major memory chip producer, Micron, saw its stock fall over 3%. And the catalyst for that drop was Micron announcing an increase in their investment guidance.
Right.
They told Wall Street, hey, we are going to spend more money to build more capacity. In any normal business environment, a company expanding to meet demand is a super bullish signal. Why on earth did the market punish Micron for trying to build more factories?
Well, this reaction exposes the underlying terror in the current market right now. It all centers on a concept called capital expenditure, or CapEx.
Okay.
Building a semiconductor fabrication plant, a fab, is arguably the most complex and expensive manufacturing endeavor on Earth. These facilities cost tens of billions of dollars. They take years to build.
And they require insane equipment, right?
Yeah, equipment that operates at the atomic level.
So when Micron says they are increasing guidance, they're essentially committing billions of dollars in cash today for a factory that won't produce a single chip for, what, 3 or 4 years?
Yes. That is the structural lag. And investors are looking at the macroeconomic landscape and asking a pretty terrifying question. Will the demand for artificial intelligence actually sustain itself long enough and generate enough actual profit to justify these multi-billion-dollar CapEx black holes?
Oh, I see. It's like a railroad company during the gold rush announcing they're going to spend $10 billion laying track across the desert. If the gold rush continues, they look like absolute geniuses.
Right.
But if the gold dries up before the track is even finished, they just bankrupted the company for a bridge to nowhere.
That captures the sentiment perfectly. I mean, Micron's stock had already run up dramatically over the past year. So when a stock is priced for absolute perfection, any reminder that the company has to burn mountains of cash just to stay in the race, well, it can really spook institutional investors.
So they bail.
Yeah, they start rotating their capital. They sell the established player that requires heavy maintenance capital, and they pour it into the shiny new ADR of SK Hynix, which represents pure momentum. It really shows how fragile this tech rally is beneath the surface. It's driven by this fear of missing out, but counterbalanced by a very real fear of overbuilding.
And, you know, that capital rotation doesn't just stop at the semiconductor level. The billions of dollars being generated by this tech boom, the wealth being created by these soaring valuations, it all has to live somewhere.
Exactly. It requires infrastructure.
Right, a financial infrastructure capable of operating at the speed of the internet. Which actually brings us to the second part of our deep dive, the changing definition of a bank.
We are definitely witnessing a fundamental rewrite of financial plumbing right now.
Yeah, so the major regulatory news in our stack today is that Circle Internet Group just won final approval from the Office of the Comptroller of the Currency, the OCC, to establish a national trust bank. And it's going to be called Circle National Trust.
Right.
Now, for context, Circle is the company behind USDC, which is a stablecoin. They had a massive $1.1 billion IPO last year, really riding the wave of the Genius Act that took effect in July 2025.
Yeah, it was huge for them.
Now, their CEO, Jeremy Lair, is claiming this charter brings blockchain technology into the, quote, core of the U.S. financial system. But before we analyze the market reaction, can you break down the regulatory mechanism here? Like, what exactly is the OCC and why does a crypto company want a charter from them?
Sure. So the Office of the Comptroller of the Currency is an independent bureau within the U.S. Treasury Department. It was actually established by Abraham Lincoln in 1863 to fund the Civil War and create a unified national currency.
Oh, wow, 1863. Okay.
Yeah, it goes way back. Today, it charters, regulates, and supervises all national banks. So if you have national or NA in your bank's name, you answer to the OCC. Getting a charter from them is basically the ultimate federal stamp of legitimacy in the American financial system.
But wait, Circle isn't issuing credit cards or offering auto loans. I mean, they issue a digital token on a blockchain. Why are they a bank?
That is where the specific type of charter really matters. Circle did not apply for a standard commercial bank charter. They applied for a national trust bank charter.
Okay, what's the difference?
Well, to understand the difference, you have to look at how a traditional bank operates. A traditional commercial bank operates on a fractional reserve system. When you deposit $100 into a checking account, the bank doesn't keep your $100 in a vault.
Right, they lend it out.
Exactly. They keep a small fraction of it on reserve, and they lend the rest out as mortgages or business loans. So they are actively multiplying money and taking on credit risk.
Whereas a trust bank operates differently.
Right. A trust bank provides fiduciary custody. If you give a trust bank an asset to hold, their legal obligation is just to hold it safely on your behalf, not to lend it out and gamble with it.
Okay.
And Circle's core product, USDC, is a stablecoin pegged to the US dollar. So for every digital USDC token in circulation, Circle is supposed to hold one actual US dollar or a highly liquid equivalent like short-term treasury bills in reserve.
So they're basically claiming, hey, we aren't a traditional bank taking lending risks. We're just providing one-to-one digital custody.
Yes, exactly. And by securing this national trust charter, they are bringing the custody and reserve management of those billions of dollars directly under federal oversight. It essentially allows them to bypass a patchwork of 50 different state money transmitter licenses and just operate under a single unified federal framework.
Which, I mean, sounds incredibly efficient on paper.
Yeah.
But this charter is generating massive political and industry blowback.
Oh, absolutely.
Now, looking at the sources, Senator Elizabeth Warren has been incredibly vocal in her opposition. And I have to state clearly here, we're not taking a political side or endorsing any viewpoint. We're purely reporting on the arguments presented in our source material.
Right, maintaining strict neutrality.
Yes. So looking at her arguments, she isn't really making an emotional appeal. She's making a strict statutory argument. She points to the National Bank Act and argues that firms whose sole business is dealing in digital assets simply do not meet the legal definition of a bank.
It's a really profound legal debate about the boundaries of that 1863 law. But, the pushback isn't just coming from lawmakers.
Right, the traditional banks are furious.
Yeah, the traditional banking industry is raising massive red flags about the economic advantages this charter creates. Groups like the National Community Reinvestment Coalition and the Independent Community Bankers of America, the ICBA, they're pointing out what a trust bank charter exempts a company from doing.
Okay, let's break those exemptions down. What does a traditional bank have to do that Circle National Trust will not have to do?
The first major exemption is the Community Reinvestment Act, or the CRA. Passed in the 1970s, the CRA legally requires commercial banks to meet the credit needs of the specific communities in which they operate, particularly, low and moderate income neighborhoods.
So they have to lend locally.
Right. If a bank wants to open branches or merge, regulators look at their CRA score to ensure they aren't just taking deposits from a community and refusing to lend back into it. But because a national trust bank does not issue loans, it is fundamentally exempt from the CRA.
Okay, so no community lending obligations whatsoever. What else they're exempt from?
The second major piece is deposit insurance. The ICBA points out that a trust bank is not required to be insured by the Federal Deposit Insurance Corporation, the FDIC.
Okay, and that's the safety net for consumers, right?
Exactly. If a traditional bank fails, the FDIC steps in and guarantees customer deposits up to $250,000. It prevents bank runs. A trust bank does not carry that federal backstop.
I have to admit, I really don't understand the logic of allowing this. You look at Circle, you look at Sony, which also just got conditional approval for a digital asset trust bank.
Yeah.
Are these tech conglomerates just exploiting a massive regulatory loophole?
Well, that's the argument a lot of traditional banks are making.
I mean, they get the prestige of being a national bank.
Right.
They get the federal preemption over state laws, but they don't have to pay into the FDIC insurance pool, and they don't have to fulfill community lending quotas. How does the OCC justify creating a two-tiered system where traditional banks carry all this heavy, expensive regulatory baggage while tech companies get a lightweight pass?
The regulatory justification essentially comes down to the isolation of risk. The argument in favor of these charters is that a fully reserved, one-to-one trust bank is mathematically safer than a fractional reserve bank.
Because they aren't lending it out.
Exactly. If Circle actually holds a short-term U.S. Treasury bill for every single USDC token they issue, there is theoretically no credit risk. There shouldn't be a bank run because the money isn't loaned out to, say, a struggling commercial real estate developer.
Okay, I see the logic.
Proponents argue you shouldn't force a company that doesn't lend money to comply with lending regulations like the CRA.
But the traditional banks are saying consumers won't understand the difference.
Yeah.
If a customer sees the words National Trust and assumes it operates like their local Chase or Bank of America, they might assume FDIC insurance exists where it actually doesn't.
That is the core of the ICBA's argument. The blurring of the lines creates consumer confusion. But from Circle's perspective, this charter is about survival and dominance. The stablecoin market is becoming incredibly crowded.
Yeah, our data shows Circle's stock initially spiked 15.6% on this news, but settled back down to just a 5.7% gain by the close.
Right. Analysts were calling the initial reaction overly optimistic because a regulatory charter doesn't guarantee market share. Circle is currently fighting a declining market value for USDC, while competitors like OpenUSD, which is backed by heavyweights like Stripe and Coinbase, are entering the arena.
It's a turf war.
Absolutely. Everyone realizes that stablecoins are becoming the settlement layer of the internet. They're the rails upon which global commerce will run. So Circle getting this OCC charter is an attempt to build a regulatory moat, to establish themselves as the officially sanctioned digital twin of the US dollar.
But that tepid stock close indicates Wall Street knows a charter doesn't eliminate competition. It just changes the battlefield.
Precisely.
So we have these two massive digital narratives running parallel. We've got the semiconductor firms pouring billions into the physical hardware of AI, and the crypto firms building the digital settlement layers to move that wealth around. But all of this digital infrastructure requires massive physical logistics.
Yes, it really does.
You can't build a data center without steel, you can't ship servers without cargo planes, and you can't run any of it without energy. So if we want to know if this tech boom is sustainable, we have to look at the physical supply chains underpinning it.
We have to step out of the cloud and look at the physical, traditional economy.
Right. And our sources highlight two traditional corporate bellwethers today, Delta Airlines and WD-40. Now, Delta just reported their Q2 earnings, and they topped expectations. They also provided very strong profit guidance for the summer.
Which is impressive given the environment.
Totally.
Right.
What caught my eye in their report is how they managed their expenses. They absorbed significantly higher fuel costs over the quarter, and they were able to do that specifically because of strong corporate travel demand. Now, the stock did see some intraday volatility, dipping at about 1.5%, but zooming out, they are up over 28% year-to-date and just announced a dividend increase.
The distinction between corporate travel and leisure travel is a crucial macroeconomic indicator here.
Break that down for me. Why does Delta care who is sitting in the seat, as long as the seat is paid for?
Well, it comes down to price elasticity. Leisure travel is highly elastic.
Meaning it changes easily based on price.
Right. If a family of 4 is planning a vacation and the price of jet fuel spikes, driving ticket prices up 20%, that family will simply decide to drive to the beach instead or delay the trip entirely. The demand disappears when the price goes up.
Makes sense.
But corporate travel, however, is largely inelastic. If a multinational corporation needs to send a team of engineers to oversee the construction of a new semiconductor fab or, close an acquisition in another country, they have to fly. They will pay whatever the premium fare is, often booking last minute at the highest possible price tier.
So Delta absorbing fuel costs because of corporate travel tells us what about the broader economy?
It signals that corporate balance sheets outside of the tech sector are highly resilient right now. Businesses are generating enough revenue that they are not aggressively cutting their travel budgets. They're willing to absorb the inflated costs of doing business to maintain their physical operations and client relationships.
And we see that physical maintenance reflected in WD-40. The company that makes the multi-purpose spray beat their Q3 forecasts, and their shares jumped nearly 10% in after-hours trading. I mean, it's almost comical comparing WD-40 to SK Hynix, but it is the ultimate staple. Whether you are maintaining a massive industrial manufacturing line or just fixing a squeaky garage door, you consume that product.
It's the ultimate physical world indicator.
Exactly. WD-40 literally fixes the squeaky hinges of the world, just like Delta is navigating the squeaky hinges of global oil markets. But I want to tie this corporate performance to the broader debt markets. The data notes that the 10-year Treasury yield ticked up slightly today to 4.56%, but that generally we've seen a pullback in yields recently. Mechanically, how does a pullback in Treasury yields help a company making physical goods?
To understand the impact, we have to define what the 10-year Treasury yield actually represents. When the U.S. government needs to borrow money, it issues bonds.
Right.
The yield is the interest rate the government has to pay investors to buy those bonds. Because the U.S. government is considered a risk-free borrower, I mean, they can always print more money to pay you back, the 10-year yield serves as the absolute baseline cost of money in the global economy.
It's the floor for interest rates.
Exactly. Every other interest rate, from a 30-year mortgage to the rate a corporation pays to issue their own debt, is pegged to that 10-year yield, plus an additional premium for risk. So when the 10-year yield pulls back or drops, the cost of borrowing money drops across the entire economy.
And why does that benefit a company like WD-40 or a manufacturing firm more than, say, a software startup?
Because traditional physical businesses are highly capital intensive. They require massive amounts of debt to build warehouses, buy raw materials, and maintain global supply chains.
While software just needs laptops and coders.
Right. A software company scales by writing code. A physical company scales by buying concrete and steel. So when bond yields drop, these traditional companies can refinance their existing debt at lower rates, instantly freeing up cash flow on their balance sheets.
Oh, wow. So they just get more money to work with.
Exactly. It drastically reduces their operating costs, which makes their earnings reports look fantastic, and that drives the stock price up.
That makes perfect sense. The cost of their debt goes down, so their profit margins widen, even if they sell the exact same amount of product. But there is one major input cost for the physical economy that isn't playing by the rules, and that is oil.
Oil is always its own beast.
Yeah. The data shows Brent crude, the global benchmark, actually dipped to $76.01 a barrel today. It pared back earlier jumps despite what appears to be escalating geopolitical chaos.
Right, in the Middle East.
Yeah. The sources note ongoing concerns about the Iran conflict and the potential for blockages in the Strait of Hormuz. We also have a high-profile data point. Former President Donald Trump posted on social media declaring that the ceasefire with Iran is, quote, over.
Which is a heavy statement.
It is. And again, just as a guardrail, we are not endorsing or condemning that statement. We are completely neutral on the politics. We are merely reporting it as a factual data point that oil traders have to look at.
Right, it's a variable in their models.
Exactly. So I need you to explain this disconnect. If high-profile figures are declaring the ceasefire dead, and everyone is terrified about oil tankers being blocked, why on earth is Brent crude dropping to $76? I mean, during previous escalations, we saw it spike well over $100. Are oil traders just ignoring geopolitical reality, or do they know something we don't?
The oil market is arguably the most unsentimental, ruthlessly pragmatic pricing mechanism in the world. To understand why crude is at $76 today, you have to separate the risk premium from the physical supply and demand fundamentals.
Okay, define the risk premium for us.
The risk premium is the extra money buyers are willing to pay today out of fear of what might happen tomorrow. When conflict first breaks out in the Middle East, panic sets in. Traders look at a choke point like the Strait of Hormuz, which sees roughly 20% of global oil consumption pass through it every single day, and they price in the absolute worst-case scenario, a total closure.
And that fear drives the price to $120.
Right. But fear is a depreciating asset.
It wears off if nothing actually blows up.
Precisely. As weeks and months pass, if the tankers are still successfully navigating the strait, the market realizes the worst-case scenario hasn't actually materialized. The risk premium deflates. The traders stop trading on headlines and start trading on actual physical barrels hitting the market.
And right now, despite the broken ceasefires and the rhetoric, the physical oil is still flowing out of the Middle East without significant interruption.
Exactly. So supply is steady.
What about the demand side then?
The demand side is where the macroeconomic pressure is really building. Remember that 10-year Treasury yield we just discussed?
Yeah, at 4.56%.
Right. At 4.56%, interest rates globally are still significantly higher than they were a few years ago. High interest rates are deliberately designed by central banks to slow down economic growth to combat inflation.
Okay.
So when global economic growth slows down, factories produce less, shipping companies move fewer goods, and consequently, the world burns less diesel and jet fuel.
Oh, I see. So traders are looking at a situation where supply is uninterrupted, but global demand might actually be shrinking because borrowing money is too expensive.
Exactly. The $76 price tag is the market essentially calling the bluff of the geopolitical tension. They are looking at softening global demand and robust physical supply, and they are saying, show us the physically blocked ships, show us the actual destroyed infrastructure. Until then, we are not paying a panic premium.
Wow. So we have corporate profits holding steady, borrowing costs easing slightly, and energy prices relatively subdued. On paper, the macro environment for the corporation looks incredibly stable. But what about the human capital?
Right, the people actually doing the work.
Let's look at the actual people showing up to work at these facilities. We have the latest labor data from Statistics Canada for June 2026. And because the U.S. and Canadian economies are so deeply intertwined, this serves as a highly accurate leading indicator for the broader North American labor pool.
It's a great barometer.
Now, I'm looking at the headline numbers, and they seem incredibly benign. Employment was little changed, adding about 18,000 jobs. The unemployment rate actually ticked down slightly to 6.5%. If I just read the first paragraph of this report, I'd assume everything is totally fine. But when you look at the sector breakdown, the foundation looks cracked.
Yeah, the headline unemployment number often obscures massive structural shifts occurring beneath the surface.
Right. The discrepancy that jumps out to me is between services and manufacturing. The accommodation and food services sector added 15,000 jobs in June, but the manufacturing sector lost 17,000 jobs. And if we zoom out to January of 2025, the manufacturing sector has shed 61,000 jobs.
That's a huge shift.
The report explicitly cites tariff uncertainty as the primary driver for these losses. Walk me through the mechanics of that. How does the mere threat of a tariff cause a factory in Ontario to fire workers?
It brings us back to the concept of capital expenditure, CapEx, that we discussed with Micron. Manufacturing is a heavy, slow-moving industry. If a company wants to build a new assembly line for automotive parts, they have to commit millions of dollars in capital today, expecting to sell those parts across the U.S. border for the next decade.
Okay, and a tariff is a tax placed on those imported goods by the receiving country.
Which raises the price of the part for the end consumer.
And reduces demand.
Exactly. So when governments begin threatening new tariffs or altering trade agreements, they inject radical uncertainty into those decade-long financial models. The manufacturing executive looks at the shifting political landscape and realizes they have no idea what their tax burden will be at the border next year.
So what do?
Their response is immediate. They freeze, they cancel the factory expansion, they delay upgrading the machinery, and they stop hiring. If the uncertainty persists, they begin shedding jobs to protect their profit margins. Tariff uncertainty basically paralyzes industrial capex.
But wait, this brings me to a massive contradiction. We spent the first 20 minutes of this deep dive talking about SK Hynix raising $26 billion and an unprecedented capital expenditure boom in artificial intelligence.
We did.
Tech companies are spending hundreds of billions of dollars on infrastructure right now. Why on earth isn't that ocean of capital translating into a boom for blue-collar, physical job growth? If SK Hynix is booming, why are we losing manufacturing jobs?
Because the AI capital expenditure boom is historically isolated. It is highly concentrated in very specific, highly specialized nodes of the economy. The billions of dollars being spent by Microsoft, Google, and Amazon are flowing into the procurement of highly advanced semiconductors, the construction of massive data centers, and the massive energy grids required to power them.
So it's enriching the people who design the chips and the people who write the software.
Yes. It creates incredible wealth for semiconductor engineers in California, specialized fabrication workers in Taiwan, and data center architects. But it does virtually nothing for a mid-tier automotive parts manufacturer in Ontario or a textile plant in the American Midwest.
The capital's flowing into server racks, not traditional assembly lines.
You are witnessing a bifurcated economy where the digital infrastructure is experiencing a golden age, while the physical manufacturing base is slowly hollowing out under the weight of geopolitical trade friction.
And the data shows exactly where those displaced workers or new entrants to the workforce are ending up. The report notes that youth unemployment, those aged 15 to 24, fell to 12.7%, and the summer job market for returning students actually looks decent at 15.3%.
But the devil is in the details there.
Yeah, when you look at where the youth are employed, the numbers are stark. The unemployment rate for 15 to 16-year-olds is over 30%. The ones who do have jobs are overwhelmingly in retail at 25.7% and food services at 23.3%.
Which perfectly aligns with the sector growth we just saw, 15,000 jobs added in accommodation and food services.
Exactly. As manufacturing shrinks, the pathway to entry-level employment is almost entirely reliant on the service sector. You are basically swapping full-time, relatively stable industrial jobs that traditionally offered benefits and a pathway to the middle class for part-time, highly elastic hospitality jobs.
And we also see a severe geographic bifurcation in this data. A digital economy is borderless. A physical economy is deeply tethered to geography.
Right. The regional numbers are wildly divergent. Provinces like Nova Scotia and Saskatchewan saw employment rise, likely tied to local resource extraction or stable public sectors. But look at the territories in the north.
It's rough up there.
The Yukon is sitting at 7.3% unemployment. The Northwest Territories are at 8.1%. And Nunavut is facing a staggering 11.6% unemployment rate.
When you have an economy increasingly driven by digital services and high-end tech capex, remote and geographically isolated regions suffer disproportionately. I mean, you cannot build a massive AI data center in Nunavut without insurmountable logistical and energy costs.
And if the broader manufacturing sector is shrinking, there are no peripheral industrial jobs moving into those regions to pick up the slack.
Right. The 11.6% unemployment rate is really a symptom of an economy that no longer requires broad geographic distribution of labor to generate wealth at the top.
So if we synthesize this labor picture, wages are technically up 3.3% year over year. People are finding work, largely in restaurants and retail. The headline unemployment rate is a respectable 6.5%. But that brings us to the final, most visceral piece of our source material today. Because despite wages ticking up, the ground-level reality for the average worker is one of intense, suffocating financial pressure.
This is where macroeconomic theory meets the kitchen table.
Yeah. We have a report examining consumer behavior and retirement data, and it paints a picture of a population stretched to the absolute breaking point by the cumulative effect of inflation. First, the retail signal. Walmart, the largest retailer on the planet, is aggressively slashing prices on core staples.
They don't do that lightly.
No, they don't. They are implementing double-digit price cuts on ground beef and dropping the price of Coca-Cola multi-packs by over a third. And they aren't doing this as a promotional stunt. They are doing it because consumer sentiment, which is measured by the University of Michigan, has plummeted to 44.8.
A reading of 44.8 is deep recessionary pessimism. It indicates that the consumer's psychological resilience is just broken.
And the mechanism behind Walmart's decision is fascinating. Walmart operates on incredibly thin margins. They rely on massive volume. So when a retailer of that size cuts the price of ground beef, it means their internal supply chain data is showing a catastrophic drop in velocity.
Right, the product is literally sitting on the shelf.
People are walking up to the meat counter, looking at the price per pound, and physically putting the beef back down. They literally do not have the disposable income left at the end of the week to buy protein.
It is the ultimate real-world indicator of budget exhaustion. The wage gains of 3.3% have been entirely consumed by the compound inflation of housing, insurance, and food over the last 4 years.
Which leads to the most devastating consequence in our data stack today. This cost of living squeeze isn't just forcing people to buy cheaper groceries. It is forcing older workers into a permanent, mathematically disastrous financial decision.
The retirement trap.
Yes. Specifically, they are choosing to claim their Social Security benefits early at age 62 instead of waiting for their full retirement age, which for most people retiring now is 67.
The psychology of this decision is completely understandable, but the mathematics are brutal.
Let's walk through exactly how brutal the math is. The government designed Social Security to be actuarially neutral, meaning in theory, you draw roughly the same total amount whether you claim early and get smaller checks for longer or claim late and get bigger checks for a shorter period.
On paper, it balances out.
But the monthly cash flow impact is severe. If your full benefit at age 67 is calculated to be $2,000 a month, and you hit the panic button and claim at 62 because you can't afford groceries, the government permanently reduces your check by roughly 30%. You don't get $2,000. You get $1,400.
You lose $600 a month.
Every month for the rest of your life.
And the tragedy here is the specific mechanism of inflation, which is the very thing driving them to claim early in the first place. It initiates the COLA trap.
Okay, explain the COLA trap.
Every year, Social Security implements a cost of living adjustment, or COLA, to help retirees keep pace with inflation. For instance, the projected COLA might be 2.8%, but these adjustments are strictly percentage-based. They are applied to your base benefit.
Okay, so if I waited until 67 and had my full $2,000 check, a 2.8% raise gives me an extra $56 a month.
Exactly. But if you claimed at 62, your base is permanently locked at $1,400. A 2.8% raise on $1,400 only yields an extra $39 a month.
Oh, man.
In year one, it feels like a minor difference, but over 10, 15, or 20 years of retirement, the compounding effect is massive. Every single year, the absolute dollar gap between the retiree who waited and the retiree who claimed early widens.
So the person who claimed early to beat inflation mathematically guarantees that inflation will erode their purchasing power faster every single year until they die? It's like being trapped in a lifeboat in the middle of the ocean, dying of thirst and choosing to drink seawater. The moment you drink it, it feels like relief. It wets your throat. It solves the immediate panic. But biologically, the salt in that water requires your kidneys to use more liquid to flush it out than you actually ingested. It actively, mathematically accelerates your dehydration. By claiming Social Security early to solve today's grocery bill, you are just accelerating your poverty at age 80.
That is a brutally accurate analogy, and unfortunately, the math gets even worse if they try to supplement that early check.
Right, because a lot of 62-year-olds think they can claim the $1,400 a month and just work a part-time retail job to make up the difference.
But they slam directly into the earnings test threshold.
Right. The government penalizes you for working if you claim early.
Yes. If you are under your full retirement age and you claim benefits, the Social Security Administration currently withholds $1 of your benefits for every $2 you earn above a certain limit, which is roughly $24,480 in 2026.
Wow.
So a 62-year-old taking a part-time job at Walmart to afford the ground beef might actually be handing half of their earnings right back to the government in withheld benefits. It is a punitive system for those trying to bridge the gap.
And we haven't even touched on the darkest piece of the invisible math, the survivor benefit. This is the hidden landmine for married couples. Walk us through how one spouse's decision at 62 dictates the other spouse's reality at 85.
When a married individual passes away, their surviving spouse is entitled to inherit whichever Social Security check was larger. If a husband was the primary breadwinner, his check dictates the financial floor for his widow.
Okay, so if he waited, she gets the larger amount.
Right. But if he panics at age 62 and permanently reduces his benefit to $1,400 to pay for today's living expenses, he has permanently crippled the survivor benefit. If he passes away 20 years later, his widow is now locked into receiving that reduced $1,400 for the remainder of her life, long after the initial crisis that prompted the early claim is completely forgotten.
It is a temporary problem. A spike in inflation at the grocery store, forcing a permanent, mathematically detrimental decision that alters the trajectory of a family's generational wealth. So let me speak directly to you, the listener. If you are approaching this window, or if you are watching your parents struggle with this exact squeeze right now, you have to look at the math, not the panic.
You have to find a way to delay.
The most critical financial maneuver you can make in your 60s is finding a way to build a bridge to delay claiming. Can you find part-time work that deliberately stays under that $24,000 earnings threshold? Can you aggressively trim fixed housing costs? Because locking in that 30% larger base benefit at 67 is the only mathematical shield you have against a decade of compound inflation.
It really is the difference between having dignity in your final years and living in perpetual financial terror. Unlike a bad stock pick or a rough quarter in business, the decision to claim early is one of the few things in personal finance you truly cannot take back once the window closes.
We have covered a massive expanse of the economic landscape today. We started at the absolute pinnacle of technological valuation, looking at SK Hynix pulling in $26.5 billion in a single day. We explored the mechanics of the AI bottleneck and how the fear of capital expenditure is driving volatility even for established players like Micron.
We examine the shifting definition of money itself, looking at Circle's attempt to use an OCC trust charter to embed digital assets into the core of the U.S. financial system, and the fierce debate over what regulatory burdens a modern bank should carry.
We looked at the resilience of the traditional economy, how Delta Airlines leverages inelastic corporate travel, and how a slight pullback in the 10-year Treasury yield provides oxygen to capital-intensive staples like WD-40. We explored how oil traders are aggressively pricing out geopolitical panic, focusing purely on physical supply and demand.
And then we brought it down to the human reality. The bifurcation of a labor market shedding manufacturing jobs due to tariff uncertainty while expanding low-wage hospitality roles.
Leading us finally to the kitchen table, where the compound pressure of inflation is forcing everyday consumers to make irreversible, self-destructive choices regarding their retirement, all driven by the price of a pound of ground beef.
When you lay all of these narratives out side by side, it highlights a deeply unsettling reality about where we are as a society. I mean, we live in an era where artificial intelligence can process trillions of parameters in milliseconds to optimize global supply chains. We live in a world where blockchain technology can instantaneously settle millions of dollars across sovereign borders without a human middleman.
It's incredible.
We have engineered the most complex, efficient digital infrastructure in the history of human civilization. Yet, the single most profound economic decision a human being will make in their lifetime, how to fund the final decades of their existence, is still an entirely analog, irreversible math problem. And tragically, it is a decision routinely made in a state of sheer panic in aisle 4 of a grocery store. We have brilliantly modernized the financial infrastructure of the world, but we have completely failed to modernize the financial safety net of the individual.
That is a staggering disconnect. The technology is accelerating into the future, but the human beings building it are trapped in the mechanics of the past. Thank you for joining us on this deep dive. Take a hard look at your own financial infrastructure. Understand the mechanisms driving your investments. Secure your career against these shifting sectors. And whatever you do, fortify your retirement bridge before the panic sets in. Until next time.